Welcome to the Value Investor channel.
Hey value investors, welcome back to the Value Investor channel. In this week's episodes, we will be speaking about the Chinese Evergrande Group and more specifically if the company would pass our debt and solvency test. So as you may have heard and seen is about Evergrande, they were lately a lot exposed in the press related to payment issues, specifically on bonds and more specifically their offshore bonds where they were missing a couple of deadlines. Before we go into the analysis of Evergrande, as always, the usual financial disclaimer that this content is for informational and educational purposes only and is not a direct offer or solicitation of an offer to buy or sell. So let's get started. So let's look first, who is Evergrande? So Evergrande is actually the 122nd on the Fortune Global 500 list. So it's a huge company which serves actually and which is involved in 8 major industries. So they are active in real estate, new energy, autos, property services, and or they even have a theme park, so that is called Evergrande Fairyland, and they're providing even health services and a lot of other things. So they do employ around 200,000 employees in China, and they are linked, according to some statistics, to 3.8 million of jobs, and they create more than 3.8 million jobs every year. So if you look at their main revenue pillars, so obviously the property development, and this is where the whole debt conversation comes from, is the biggest part of their revenues. So investment property and property services, those also play some important role, but really more than 80% of their revenues are linked to property development. And specifically, they are mostly present in the east of China, so the Shandong regions, Guangdong, Guangxi, Hunan, etc. So they are a lot present there in terms of property development, which are the regions that are currently having most Evergrande residential projects for sale or that are actually scheduled for sale. Why are we discussing today? So it's October 2021. Why are we discussing this? So there is an issue happening in China, and we'll come back to this when we'll speak about the Chinese government implementing the 3 red line principles, so that the average house price in China has been growing like crazy since now half a decade. And it becomes less and less affordable for the people. And some people are actually saying, as money is so cheap, which is indeed the case due to low interest rates, that there is a creation of a bubble. And some people say actually that Evergrande is the expression of this real estate bubble that may implode and will have a domino effect on the financial markets. So before we move forward, one interesting point just to refresh everybody's mind is about this bubble definition, or what creates bubbles. So in fact, when we are looking at real estate bubbles, and it was the same during the subprime crisis, initially what happened is there was a very rapid increase in the market price of property until the prices at a certain point in time, they become they reach unsustainable levels. And then obviously there's going to be a decline, so they're going to be corrected. And you can look into this specifically when you have a gap that builds up between the fair value, so the real value of the asset, and really the market value. When that gap grows exponentially, you will very probably be in a bubble creation scenario. And in fact, the Chinese authorities, they saw this. They saw the levels of debt that were growing. They saw the prices of land also that were rising incredibly high in China, and also the real estate sales that were booming. And in August 2020, the Chinese government, in fact, defined and imposed 3 attributes that the real estate developers had to follow in case they would continue, or they would like to continue to grow their depth. And so it's called the 3 red lines guidance. And the 3 red lines guidance actually, and the 3 attributes relate to that, they are linked to, first of all, that the liability to asset ratio from a balance sheet of those companies, of the real estate developers, the Chinese government is forcing them to have a liability to asset ratio excluding the advance receipts, so advance payments of the owners, that is below 70%. A net gearing ratio of less than 100%, that's the second attribute. And the third red line that real estate developers cannot cross is the cash to short-term debt of more than 1 time. So that's a ratio that they need to follow as well. And what is interesting, what the Chinese government in fact has decided and imposed on those real estate developers is that if they are matching those 3 red lines, so if their liability to asset ratio is indeed below 70%, the net gearing ratio below 100, and the cash to short-term debt is more than 1 time, so they have enough cash to support the short-term debt. So they can continue to grow their debt by 15% on an annual basis. And if they do not match 1 criteria, they can only grow the debt by 10%. If they do not match 2 of those 3 criteria, the annual growth in debt of those real estate developers can only grow by 5%. And if they do not match the 3 criteria, which in fact is the case for Evergrande, we're going to see that later on, they indeed are absolutely not allowed to grow the debt. So the growth of the debt can only be at 0%. And this is something that also UBS has been sharing in an interesting document in January 2021. If you look also at the let's say the price of Evergrande being quoted on the Hong Kong Stock Exchange, what was interesting to see is that so after August 2020, the share price was at around 28 Hong Kong dollars, and today it's at 3. So obviously the let's say the speculators, I don't think those are investors, but the speculators, they saw that Evergrande was overpriced at 28, and there was a sell-off that happened, and the sell-off continues up to today. And so if you're interested, you can look on the Hong Kong Stock Exchange. Evergrande, the ticker is 3333. And you're going to see that between August 2020, where the stock was priced at around 28, it's now, the stock price has been divided by 10. So what we are looking here is specifically analyzing the debt. And for those who are interested, you can have access to a depth value investing course on Skillshare and Udemy platforms that is called The Art of Value Investing. But here we're going to look specifically at the Evergrande debt, and we're going to look at a couple of interesting ratios that are part of our fundamental tests. One being the low debt to equity, and the other one being also how external rating agencies, what was their sentiment about the debt that is carried by Evergrande in their balance sheet. So if we start with analyzing the debt to equity ratio, already when looking at the annual and quarterly reports of Evergrande, there is already one thing that is pretty interesting to see, is that they are carrying bonds, not only obviously, the stock listing on the Hong Kong Stock Exchange with a ticker 3333 is obviously listed, but you can already see from looking at the annual and latest quarterly report of Evergrande that they carry senior notes, or senior corporate obligations that are due short-term 2022, 2023 at a massive cost interest rate of 11, 12 and 13%, which already kind of shows, if you know how corporate bonds work, that the debt is considered as being very risky. So they need to pay off a high coupon in order to be able to gather fresh money from those corporate obligations. And what is interesting as well, and there is an interesting analysis that has been done also by Bloomberg, is that the amount in terms of millions of dollars that Evergrande has to pay, there is a lot that has to be paid between now, so end of 2021, and by end of 2023. So if you something that you need also to know is that there is in the debt that Evergrande is carrying, there is some onshore debt. So that is debt that is due and it has to be paid out to Chinese credit holders, and there is offshore debt. And the offshore debt, so this is debt where the credit holders are outside of China. What is interesting is what happens as Evergrande was short of cash over the last weeks, is that Evergrande was able to cover and to pay out part of the coupons that were due for the onshore debt, so to the Chinese credit holders, but some offshore credit holders, they would not receive the money that they should have received related to bond coupons because actually there was not enough cash in the balance sheet, so as part of the assets of Evergrande. And this obviously created a huge, so it increased the fact that markets became very nervous about, okay, will Evergrande be able to pay off already the coupons and the payments that are due already now short term, not even looking at what is the amount of coupons that have to be paid out in 2022 up to 2023. So as value investors, we obviously, and this one of a very interesting ratio that we look is the debt to equity. So the debt to equity analyzes the liabilities, and when you have a look at the balance sheet of Evergrande, and I have been looking at the consolidated balance sheet of Evergrande until end of June 2021. So those are unaudited figures because it's an intermediate quarterly report, so a half-year report. What you can calculate is that Evergrande is carrying a total amount of liabilities at to 1.966534. So it's 2 billions of yuan of RMBs, while the equity is only at 411,041. And so there is clearly an issue if you would do the calculation between the amount of liability and equity. So you divide 1966 by 411, you see that the debt to equity ratio is at 386%, so at 3.86%. And even the net debt, there is a problem. Let's be very clear. There is a problem in the amount of debt that Evergrande carries towards compared to total equity. And we as value investors, we tend to like to buy into companies where the debt to equity is below 3. So already here, let's be very clear, it's a fail in terms of debt to equity ratio for Evergrande. The second ratio, when we look at the debt of companies in general as value investors, is what we call the interest coverage ratio. So the lower the ratio, the more the company is burdened by debt expenses and less capital is available. And typically as value investors, and in general, not just the value investors, we tend to say that when interest coverage ratios are below 1.5 or lower, what the company generates in terms of profits is being nearly eaten up by the payment of interest. And with that, the company cannot grow. The company does not have any capital that remains available to be further able to expand what they do. So it's an issue. It's an issue. And if you look at Evergrande specifically, and again, looking at the consolidated statement of income ending June 30th, 2021. Again, remember, those are unaudited reports because it's not the annual report. We see that the EBIT, so the earnings before interest and tax, divided by the interest expense, so is at 150. So the interest coverage ratio at 150 means that nearly the whole profit that is generated by Evergrande is used to pay off and to make the payment of interest. So there's nothing nearly left in order to even pay out or reduce the amount of debt. Is just to cover the interests that are needed, which is pretty dramatic. The second ratio that as investors we like to look into is the operating profit before interest. And there indeed also the, if you would add the operating profits and you would add it indeed and you would divide it by the interest paid, you're gonna be at a ratio of 1.73. So again, there is not enough profits generated by the company to cover, or it's really very short to pay out what is in terms of interest needed, and what the company has to pay out to the creditor. So that's pretty problematic here. So again, we would clearly classify the interest coverage ratio as a fail. So that's a sign for us that we would not invest into that company. One of the conversation that is coming up with Evergrande is indeed if something happens to Evergrande that the debt cannot be paid back, to those external creditors, and you have understood there are some onshore, so some Chinese creditors and some offshore, so some external ones. So what is interesting to understand is who is exposed to the bonds of Evergrande. There has been interesting articles about this, about who are either the domestic credit holders or the international credit holders. And in fact, there are a lot of banks like the Agricultural Bank of China, the ICBC, that's the Construction Bank of China, but also some international banks that have a certain amount of exposure to the Evergrande bonds, like BlackRock, UBS, HSBC. So yes, what happens if Evergrande goes bankrupt? Those banks will be sitting on bonds where they will not see the money coming in because they are the credit holders, because Evergrande is just, they do not have the possibility to pay back those banks. So that's something that we will have to continue to observe what will be happening in the upcoming weeks. As you have, or what I said earlier, is that it's not just now that there are some coupons that are due, but there are many payments that are due between now and the end of 2022 and also into 2023. If one of the interesting tests that I wanted to make as well is also to analyze the 3 red lines that were defined by the Chinese government in August 2020. So the first one, which looks at the ratio between liabilities and the assets, excluding prepayments. And there you remember that the first red line asked or requested by the Chinese government is to be below 70%. And when you do the math, you see that on the amount of liabilities, if you remove indeed the prepayments, you're at 88%. So clearly the liability to assets is too high compared to the first red line of the Chinese government. So already here you have one of the 3 which is a fail, where Evergrande will already not be able to grow the debt by 15%, but just by missing already the first red line, they will already only be able to grow the debt by 10%. Of course, under the condition that the other 2 red lines are not crossed. Let's look now at the second red line. So the second red line is the net debt to equity. And so the net debt, actually you remove cash. So you let's say subtract cash from the liabilities, because cash is available directly. It's a very liquid asset. But even with that, by reducing the liabilities with restricted cash and cash equivalents and dividing it by the equity, you are again at above 300%. And remember that the second red line defined by the Chinese government was asking that the net debt, so the difference between debt to equity and net debt to equity is that in net debt you remove cash to reduce the amount of liabilities. But even here, Evergrande is at 300%, so way beyond the 100% that the Chinese government is asking. So consequence of that, already 2 out of 3 are not matched. So the level of growth that Evergrande can have in their debt is already at 5% maximum, because they already do not match 2 of the 3 red line attributes defined by the Chinese government. So clearly, again here, it's a fail. And if we look at the third red line defined by the Chinese government, so that's the cash to short-term debt. So obviously looking at the short-term debt, you need to look at the current liabilities and removing indeed everything that is long-term liabilities. But even here you see that the amount of cash, and even if I would add the restricted cash, the amount of cash that is available to cover the short-term debt is definitely by far not above 100%. So the ratio again here is a fail. So what does this mean concretely is that Evergrande is not allowed further to grow its debt. So we are here at 0% that will be allowed by the Chinese government. What is the consequence of that? Well, we're going to discuss this, but first of all, I mean, it's not just about Evergrande. We need to look also at how the other real estate developers, they match those 3 red line criteria. And there has been an interesting article that was on, I think the website was bondevalue.com, where there was an analysis that was done, and Evergrande in fact was not the only one that was not matching the 3 red lines defined by the Chinese government in August 2020, but there were in fact 3 companies, so Evergrande, Greenland and Sinic China, while other ones, in fact what happened, and this is something that, and you see it in the press, that Evergrande has started to do, what are the options that they have? They will probably have to sell off some assets at a discounted price to be able to collect fresh money, fresh cash, or maybe they're gonna ask to their equity holders to do recapitalization, to bring in fresh cash, so to increase the amount of equity available. But they do not have too much choices. And obviously you can imagine that selling assets, what we call a fire sales, under emergency conditions, obviously if you are under pressure, you're gonna give a higher discount when you're selling off your assets like flats, like a car, when there is an urgency and you need the money tomorrow. You will be, I don't know, giving a discount of 50%, 40%, 30%, but for sure you will not sell it at a premium price. So that's really what Evergrande has really to do now, is to either recapitalize and find new money, not through debt. So they have to look at the equity holders, if the equity holders or the shareholders can, and otherwise we'll have to sell off assets. And it's kind of going into a partial liquidation scenario. So we already see that on the test of having a low debt to equity, which are fundamental screens that as value investors we look into, already Evergrande is clearly not matching this. So above 3, and also when you add the 3 red lines that the Chinese government has defined in August 2020, I mean, it's 3 times a fail as well. What's interesting also to analyze as a value investor, and again, if you look at my training that is called The Art of Value Investing, in my level 3 test, I like also to look at not only internal metrics, but also external metrics. And one of the metrics when looking at debt specifically, what it is all here about Evergrande, is looking at external rating agencies. What do they say about Evergrande? And you remember that when we were looking at the annual report of Evergrande, they were already listing, like in a 10Q report in the US, they were already listing that there were senior notes due 2022 and 2023 that were carrying a very, very high coupon rate at 11, 12, and 13%, which are huge amounts, which shows that the debt is risky. And what is interesting to see, and from the rating agencies, I like to look at Moody's, I like to look at Fitch as well. What is interesting to see is how Moody's and Fitch were rating Evergrande. And until, let's say, the summer of 2021, Moody's was rating the debt, so the corporate obligations of Evergrande as a B1, but it's very, very rapidly, just a couple of months, downgraded the credit rating of Evergrande from B1. It quickly went to B2, then to CAA1, and then to CA. So they actually have been downgrading massively since now a couple of months the, let's say, creditworthiness of Evergrande. Same for Fitch. Fitch was carrying still in September 2020 Evergrande with a rating of B+, and then they downgraded it to B- in June, CCC+ in July, and then CC in September, and by end of September they even further downgraded the rating to a C. And just as a reminder, when we look at, so typically, as I said earlier, in the rating agencies, we do have Standard & Poor's, Moody's and Fitch. Moody's and Fitch tend to give those figures available, let's say, just by registering to their websites. So before the crisis and all this news and press coverage started with Evergrande, the debt of Evergrande was already in the category of high credit risk, being rated B1 on Moody's and B+ on Fitch. So we were already not in, let's say, investment grade bonds. And now, actually, if you remember that the debt of Evergrande by Moody's have been downgraded, or has been downgraded from B1 to a CA, and for Fitch from a B+ to a C, the category actually is a near default with possibility of recovery. So, I mean, a further downgrade is that the company has to go into liquidation and the company goes bankrupt. So you see that the risk as they see it is extremely high, that the company is very, very close to default. One thing, and it's not the purpose of discussing it here, but what could be discussed is why suddenly in just a couple of months, let's say in 3-4 months, a debt that was rated as high credit risk suddenly went down to near default. So that's something that we could discuss. why the rating agencies only did this over the last 3 months. But at least what is clear is they did it, and I wanted to give you the proof that since June 2021 for Fitch, and again more or less the same time period for Moody's, they indeed have been downgrading the debt of Evergrande. But again, remember, if you would have invested into Evergrande, you were already with corporate bonds that were considered as high credit risk. So we were not in the investment grade. So here again, as a value investor, we like to have investment grades corporate bonds so that the external rating agencies consider that it's a serious company that will have enough money to pay back the external credit holders. We want to have at least a kind of BBB rating up to an A, AA, or even AAA. So clearly here Evergrande is also failing if we look at this from the, let's say, reading glasses of a value investor, has been failing on this test as well. So one of the things that I always like to do, and because I always believe that value investors, they make kind of a mystery what they have in their portfolio, I always like to also to benchmark and to compare my portfolio, my investment portfolio, with the cases that we are analyzing, and in this case we are analyzing Evergrande. And so if you remember, if you have been looking at my training or going onto my website, 36 Square Capital, this is my family fund that is being run, where I expose what are the positions when I sell and buy things. So currently I still hold Publicis, which is Media Communications, Nestle, Daimler, BASF, Danone, Unilever, Telefonica, Microsoft, and Kellogg. So I have, you see, a couple, so 7 European companies and 2 US companies. And you can see from, I mean, if you look at it from an investment grade perspective, all those companies are at least BBB, so considered with an adequate payment capacity to a strong payment capacity. And there is even one company which is Microsoft, which has a AAA, so they have the highest quality in terms of corporate obligations. And obviously looking at the debt to equity, at cash to short-term debt, at liability to assets, the interest coverage ratio, the companies that I have invested into, they match a lot of those criteria that we want to have as value investors in terms of having a low debt to equity ratio, so below 3, that the cash to short-term debt is pretty high, that the liability to assets is below 70%, that the interest coverage ratio is way above 1.5, so that the profits that the company generates, only a very, very small part is used for paying back debt and the interest payments. So, and this is a reason why on my 9 companies that I currently carry in my portfolio in October 2021, all of them match those criteria, because I do follow obviously my own rules as a value investor. So if you compare now those ratios, and this is what we have been discussing in this, let's say, session, obviously you, again, refreshing everybody's mind here that the debt to equity of Evergrande is at 3.86. The cash to short-term debt is very low. Liability to assets is way beyond 70%. The interest coverage ratio is very close to 1, so nearly all the profits of the company are being used to pay back just the interest payments of to the credit holders. And you have seen and you have heard through the looking at Moody's and Fitch that the external credit rating agencies have been downgrading strongly over the last 3 to 4 months the rating of the bonds, the corporate obligations of Evergrande. So with that, thank you for having listened in. You can find an in-depth value investing training called The Art of Value Investing on Skillshare and Udemy platforms. And don't forget to subscribe to my channel and make sure to hit the subscribe button below. Thank you.